Hello and welcome to www.multifamilystrategies.com. My name is Steve Steadele and today we'll be talking about cap rates. I have three objectives during this short video. First, to define the meaning of a cap rate. Second, to show you why cap rates vary so much from market to market. And finally, third, I'll share with you some of the biggest challenges and traps investors face when working with cap rates. So what is a cap rate, which is short for capitalization rate? A cap rate is a measure of the ratio between the net operating income produced by an asset and its capital cost. Many people believe the cap rate is the return you get if you paid all cash, and that's true. But the reality is, most investors don't pay cash. They finance the acquisition, sometimes from multiple sources. As investors get involved in the apartment business, they hear the term cap rate from other investors and real estate brokers. A cap rate measures the performance of an asset, and it's a quick and easy way to determine value, if it's done correctly. So let's look at how the cap rate is calculated on an apartment building. First, we must calculate the NOI, or net operating income, by subtracting vacancy and operating expenses from the income. Income less vacancy less operating expense equals NOI. To determine the cap rate on an investment, divide the NOI by the price. For example, if the NOI on a property is $98,342 and we buy the building for $1 million, the cap rate is 9.83%. Many gurus teach that you should buy a property at a 10% cap rate or better. There are a few reasons for this. First, it's an easy number to train people on. Suppose the NOI for this example was $100,000 instead of $98,000. That means we'd have a cap rate of 10% instead of 9.83%. Buyers want high cap rates and sellers want low cap rates. I can't even begin to tell you how many investors I've talked to over the years who told me they wanted a 10% cap rate. Sometimes that was good for them, and sometimes that was bad. Let me explain. Cap rates vary not only from building to building, but also from location to location. There are 5 different types of real estate markets: premium, growth, stable, cash flow, and poor markets. A premium market is a market where your primary return is appreciation. It's a high growth market with rapid appreciation and requires a higher down payment to break even. Some investors define appreciation as speculation, and there is some truth to the fact that when you buy in an appreciation-driven market, such as Southern California, New York City, or Seattle, you're really buying on what you believe the market will do in the coming years. Premium markets normally offer investors solid employment growth, especially in the export sector. A growth market is a market where you have a lot of commerce and migration. It has good growth and requires a moderate to high initial investment to break even. A stable market has slower growth and requires less money. A cash flow market is a market that requires minimum money down, but appreciation is slow. Most of the country is a cash flow market, which is another reason many gurus teach 10% cap rates. Finally, a poor market is a market that lacks the economic influences to justify making an investment. It's important not to confuse a poor market with a market cycle. A poor market is the type of market that will take 10 to 15 years to correct. For more information and other great tips on buying and selling apartment buildings, go to www.multifamilystrategies.com. There you'll learn all kinds of strategies and techniques about apartment investing and receive a free CD. Again, that's www.multifamilystrategies.com. Sign up today.